to where the U.S. is, to where the U.K. is. And so, we may be at the peak reopening story here in the U.S., and markets may have well priced that, but in other regions we certainly haven't. You see that in the data in terms of vaccinations and the like.
Evan, I look at all that this is, and what it is a wall of cash. I think we're getting up, some quick number in my head is 300 billion. I can't remember. There's a ton of money laying around. That's what we know for certain. Does it get deployed to quality, or does it get diffused through the market to different allocations and different assets?
Yeah, I mean, there's plenty of money on the sidelines, but also we've had a great run up. I think on an index level, it's going to be a little bit tricky from here. Investors, I think, are increasingly going to have to go active, look for individual opportunities in individual stocks, and so that is where the money we see going. But overall market index, I think it's gonna digest the extraordinary gains we've seen over the last year.
If you do think, Evan, that the reopening trade has largely been baked in the United States, do you think that this idea of reflation and inflation really picking up has been overpriced in markets? In other words, would you say that it's a good time to add duration to buy longer-dated treasuries and go against the grain of the crowd that say that this is actually one of the riskier spots?
No, I think that's a great question. So my basic view is that as much as inflation expectations have run up, we're near record highs in the index. As much as they've run up, there still has to be some risk premium in the rates market, because we don't know, no one knows if these inflation pressures are going to prove more transitory or less transitory, right? And we're going to be going through a few months of data that's going to be quite confusing, like the inflation data that we saw last week. So the markets are going to still have to price this risk premium, this uncertainty that inflation could actually surprise to the upside. And so that's why we still think that that inflation expectations remain elevated from here.
Evan, let's take an asset class. Let's pick foreign exchange. And let's think about the reaction function of each individual central bank for the majors in G10 at the moment. Do you think that's a decent framework for developing a view on the US dollar?
Yeah, I think so. So what we've seen is pretty much every central bank except Australia and the US, at least within the G10, begin a tapering process. And the US, as we know, extraordinarily dovish. I know people are getting excited about the minutes, but I don't read too much into it. As long as the Fed is intentionally putting itself behind the curve, then that should put weakening pressure on the dollar. Other countries that are both seeing more of an acceleration in the growth pickup, or earlier cycle, and then regions that have begun the tapering process, interest rate differentials between the U.S. and much of the rest of the world should continue to compress.
Evan, I want to go nerdo on you right now. We're going to do this. It's time for some math here. It's Math Thursday. There is a bond-stock correlation which is most unique right now. Lisa mentioned that Liz Ann Saunders of Schwab has really featured this in her work. Part of that is the blessed interest rate parity strategy. It doesn't work when correlations flip like this. What's going on in that space right now?
Yeah, so what we're actually seeing with the bond correlation to the S&P 500 is we've seen that turn from negative to positive very recently. So inflation concerns, yields go up, U.S. growth stocks get hit. But the way we're positioned is quite pro-cyclical. So, and there's still a negative stock-bond correlation between, say, cyclical stocks, value stocks, so we're still getting that protection there. Now, we're super aware that if inflation shoots up from here, you're going to have an issue where bonds sell off and the broader equity indexes sell off as well. That's why we have to be creative with our asset allocations, hedge, be exposed to commodities, have some of that inflation protection, and then in the less liquid space, direct real estate, infrastructure, and some hedge funds, just diversifying that portfolio beyond just 60-40.
Evan, at a time when a lot of pensions still are looking for a 7.5% annual returns bogey, what kind of returns target do you think is appropriate?
It's really tricky. I mean, we've got your standard 60-40 over the next 5 years is earning 4.5%. And yes, it's very true that the expectations of a number of investors is different from what we think markets will experience given elevated valuations right now. So, there's difficult ways to address this. It could be taking more risk, which obviously leaves some people less comfortable. I do think that one of the ways we address this, if those institutional investors can reduce their need for liquidity and can take on some of the illiquidity risk premium, then diversifying into those alternatives, you're still probably going to get better returns in general from private assets here.
Evan, got to leave it there. Send our best to the team. Evan Brown there of UBS Asset Management, the head of multi-asset strategy. How many times have we heard that one at the end there, TK? That if you need some pickup, you've got to go elsewhere and you've got to go into private markets.
Well, that's the pressure right now. Yeah, the private markets thing, that's got its own traps as well. But, John, this correlation idea is really important. Folks, what's important here is John Leese and I all have different data screens. We have our own personal way that we look at the market, always through the Bloomberg terminal. And, John, what I would say now is within the stasis, the word I used with Francine a couple hours ago, that there's just almost a jumble to the correlations on my screen right now.
Yep.
It's odd.
Diversification, the key word here, Lisa. Does 60-40 offer you that right now?
No.
And at the moment, that's the problem.
Well, yeah, at the moment it doesn't. I'm interested in the idea here that actually increasing investment, increasing allocation to private markets could create more volatility in public markets, because what do you sell when there is a bout of volatility or there's a bout of news? You sell what you can, and that's what we see on an ongoing basis, John.
Treasuries. Liquidity, the most liquid market.
March 2020.
We're talking about that. I think we're going back 10 years talking
John
about that. Maybe longer. What is it, Tom?
It's a haiku. Treasuries.
Okay.
Liquidity.
Thank you. 8 a.m. Eastern Time. Anne Milady joining us from Wells Fargo. From New York, equities are down about 14 on the S&P. We're negative about 1/3%. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. In Iran, President Hassan Rouhani says world powers have agreed that economic sanctions on his country's oil and other industries would be lifted. Negotiators in Vienna have been trying to revive a troubled nuclear deal from 2015. Rouhani says they have taken a, quote, major step. The U.S. and Iran have been holding indirect talks. A top EU official said yesterday that the two sides were close to a deal. Israeli warplanes pounded houses, weapons, warehouses, and underground tunnels in the Gaza Strip today. It's an attempt to consolidate gains ahead of what could be an imminent ceasefire, according to the New York Times. The two sides have been discussing a truce that would end Israeli attacks on the Palestinian militant infrastructure. In return, Hamas would quit firing rockets at Israeli cities. And the Democratic-controlled House has voted to create a commission to investigate the January 6th insurrection at the Capitol. 35 Republicans broke ranks with their leadership to support that probe, but the legislation's fate in the Senate is uncertain. Republican leader Mitch McConnell is opposed. Democrats would need 10 Republicans. The U.S. wants a more stable and predictable relationship with Moscow. Blinken met with Russian Foreign Minister Sergei Lavrov in Iceland. He raised a number of issues, including the Syrian civil war and the health of dissident Alexei Navalny. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
You know, I'd put us, I don't know, a little bit over 50% being able to do it, but it's going to have to come together quickly. The president doesn't want to wait. I don't blame him there. And so I think the next 2 weeks will probably be the critical time.
Senator Shelley Moore Capito there, the Republican from West Virginia, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bramwitz, I'm Jonathan Ferro. Counting you down to the opening bell, 2 hours, 12 minutes away. Equity futures down 9. We declined 0.2%, off session lows, and just climbing back a little bit here. Yields unchanged at 167 on 10s. Got something to say, Tom? That was a deep breath.
But the 10-year, John, to me it is newsworthy, tick by tick. But I'm sorry, we've gone 163 to 167 with the real yield move we've seen. You know, everybody's saying it's like dead out there, and I'm saying, well, no, actually, I don't see it dead.
Yesterday wasn't dead. We had a 3-4 basis point move on treasuries, but you didn't want to discuss it.
Look at the real yield right now. You may have to blow up the show tomorrow.
We talked about the taper conversation. You didn't want to talk about the fact they're talking about
I was focused on
Doge.
No
interest at all.
Yeah. Well, you know, I had some distractions.
He's hanging with the kids.
Doge.
Yeah.
Do you want to talk to us about Doge, or do you just want to leave that there?
No, Mike McKee has some Doge in his wallet.
He does?
It's next to his Vietnamese dong. He's got dong and he's got Doge.
ATK.
In his wallet.
No.
It's true.
No.
No, it's true.
You have a drink. Stop.
Okay.
Euro dollar 121.98. Crude 62.64. That was wrong. Carry on.
No, that's a true story. I mean, Mike McKee carries some Vietnamese currency in his wallet and probably is adding Doge to it as well. We are advantaged to digress to Wendy Benjaminson with esteemed politics and study in Washington with a lot of good perspective on where our government is. Wendy, once again, and you and I are far too young to remember 1948. Or even 1967, but once again, we have Israel and Palestine, and always of most interest, the Democratic Party is just a mess here. What does the president do to corral the herd as he tries to get to a ceasefire?
Well, I'm not sure if he's corralling the herd or the herd is trying to corral him on this. You know, the entire time that Joe Biden has been in U.S. government, America's reflexive position is Israel. We are defending Israel. We are Israel's best friend. They can do no wrong. The trouble is the next generation of Americans is coming up not seeing Israel as a tiny little country surrounded by enemies, but one of the most powerful countries in the region with a very powerful military. And a guy, Bibi Netanyahu, who's been in power for a very long time. So they see what many on the left and many younger Americans, including Jews, see as an apartheid state. And they want the U.S. to take a tougher position against Israel when it goes after Palestinians the way it is this week in Gaza, even though with the complication of Hamas firing rockets back into Israeli territory. It's much more complicated for Biden than it was earlier in his career.
I agree with the complexities and the change complexities now. What is the actual power projection that any U.S. administration has now over Israel? Because time has moved on.
Well, Tom, that's an excellent point. The United States has a lot less power against Israel than it used to. They have a great military. We provide them with a tremendous amount of military aid. We could threaten to cut that off. They don't have a lot of friends in the international community, and the United States is a big part of that, of a voice that supports them. So losing that could certainly change global opinion about Israel, and I think they want to preserve that, although Netanyahu seems to be ignoring U.S. calls for a ceasefire. So,
Wendy, our discussion of this particular point highlights how much the Biden administration faces a new landscape on a geopolitical standpoint as he engages in his foreign policy. And I'm thinking not just of Israel, but also of Iran. And the talks are continuing between the U.S. and Iran to forge some sort of nuclear deal. We've heard from Russia after their talks that they went pretty well and that possibly they could start lifting sanctions. How realistic is it for the U.S. to reach some sort of agreement with Iran to lift sanctions, allow oil barrels back into the market in the near future?
I think it's extremely possible. I mean, remember, Biden was vice president when Obama struck the deal with Iran and the 6 other countries for the Iran deal. He was a big supporter of it at the time. He's been wanting to get back into it. He's been wanting to show the world that America is re-engaging with the world when Donald Trump sort of pulled us back, into our fortress America. So, now Biden has a chance to re-engage in the things like the Paris Climate Accord and things like that, but also with things like the Iran nuclear deal. This will also anger Israel because, they are very, very opposed to the Iran nuclear deal. They think it means their destruction. And so that's another calculation Biden has to make. But I have a feeling this is going to come together.
Wendy, I got to say, it feels a little bit like Back to the Future with Biden trying to re-engage with this sort of geopolitical regime that predated Trump. And I'm wondering whether Democrats are on board with him. The idea here that some of the protectionism came not just from the Republican Party, but also from Democrats. Can you give us a sense of the tensions within the Democratic Party about this sort of international focus of Biden?
That's an excellent point because, Donald Trump took the Democrats' position that, we would protect American jobs, we would protect, that's a big union position. And Biden has presented himself, and really always has been, a real pro-union kind of guy, the guy from Scranton, the guy from the steel mills. And he very much wants to, as I said earlier, re-engage with the world, but he also wants to protect American jobs. And I think that's part of what the infrastructure push is meant to sort of balance out. The infrastructure push would create jobs, the Biden administration says, and that might mitigate some of the moves back toward internationalism.
Wendy, just quickly, there is a certain irony there because some people would blame the teachers' unions from stopping people from being able to go back to work because they kept the schools closed.
Right. And Randy Weingarten, the head of the biggest teachers union, American Federation of Teachers, said, I think it was just last week, that she was now in favor of everyone going back to school. So the idea is we get through the summer, September comes around, all the kids go back to school, and then voila, the world can fully open again. But yes, that was an issue that Biden had to navigate, wanting to reopen with the teachers unions being very opposed to it. They were afraid of catching COVID. But now that they're all vaccinated, there should be no impediment to starting school.
Yeah, Wendy, thank you. We've got to leave it there. Wendy Benjaminson there, the Bloomberg politics editor. And some people might argue, Lisa, he wasn't that successful at navigating that issue.
No, it has been a very difficult time for the schools in particular. And right now, still, it's very patchy with a lot of schools, mine included, still at home.
Still at home?
Yeah.
Still.
A lot of fun.
Doesn't vacation start now? Summer vacation, isn't that
Actually, yeah, they're going to start early, and then they're going to go back to school early to try to regain time. But I've got to say, this has been a year that has been absolutely annihilated for so many kids who have been unable to go to school and actually learn in person.
Tom's living this too.
It's a huge deal, John. John, on that Japanese vaccine thing, I'm as stunned as you are at the slow rollout in Japan. I mean,
should I read the headline?
I was about to say, did we actually break the news?
Right now.
Yeah.
And
Japan
with the Prime
approving
Minister
the
speaking.
Moderna Astra COVID vaccines, according to NHK. And when I read that headline, Tom, I was surprised that they hadn't already been authorized. It just gives you an idea how slow some countries are moving.
And how ahead we are. We haven't had enough credit for the success we've seen in selected countries, including America.
Coming up, Bob Miller of BlackRock from New York City this morning. Good morning. On radio, on TV. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City for our audience worldwide, good morning to all. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the price action this Thursday morning. Equity futures shaping up as follows on the S&P. We're down about 0.2%. Some headlines crossing from Morgan Stanley. It's a shake-up 2 days after a shake-up over at JP Morgan. Ted Pick, the architect of Morgan Stanley's trading revival, and Andy Saperstein, who built the company into a wealth management powerhouse, tapped as co-presidents. And Tom Keene, it looks like Mr. Gorman, is sticking around for a few more years, but setting up the transition for the future.
Yeah, to me, the headline here with James Gorman, age 62, and James Dimon, age 65, is how long they stay around. With Jamie, I think it's sort of indeterminate. It's like 5-ish, 7-ish. It's in the cosmic mist of Park Avenue. For Mr. Gorman, it seems to specify 3 years, so we get a little more specificity on what these successful leaders are going to do.
Sharon Yeshaya will become the CFO, Tom. The CFO, John Pruzan, to become the Chief Operating Officer. A rejig elsewhere as well. All happening in the same week. It's interesting, isn't it, TK? JP Morgan a couple of days ago, Morgan Stanley this morning.
But I would fold it right into the compensation battles at the other bank. What this is about, John, is we're trying to get back to normal. The pandemic's coming to an end, and all this stuff has been delayed 6 months, 8 months, you know, just survival and serious survival with real illness and death, frankly, at these firms. And it's all sort of coming in a wave, and I suggest we see a lot more. What I would focus on, John, is within the firms, it's not the battles, and the media loves, pick against, you know, Saperstein and all that. What I would focus on is the skill sets and the different character and culture of the firms. There is a Morgan Stanley way, and you see that with a kid from Middlebury in Pick, and you see it, frankly, in Pruzan with his commitment from Tufts. Each of these kids has a different culture and past that they bring to this advancement.
Inevitably, though, we'll be talking about the heirs to Mr. Dimon, to Mr. Gorman, and we're doing that this morning. Pick and Saperstein emerging as the likely heirs of James Gorman over at Morgan Stanley. But maybe more crucially for a lot of people waking up this morning and seeing these headlines, Lisa, this from James Gorman, the CEO. He's told the board he plans to remain CEO for at least 3 years. Now, the joke over at JP Morgan is the rolling 5-year view of Jamie Dimon. It's another 3 years for Mr. Gorman.
At least 3 years, even as there is this shakeup just under him. I got to say, you asked the question, John, why now? What is this a coincidence that we're seeing all of these shakeups in the same week? And I would argue it comes ahead of next week's hearings in Washington, D.C.
You're not the first to say this.
I know I'm not the first to say this. I'm not original when I say this, so don't
that.
worry. I'm going to definitely credit all the people I've stolen this from.
I'm just suggesting that this is an argument that is building,
yes,
that they're rejigging things going into next week.
And I think that they're trying to take on a more responsible, more diverse kind of view, basically saying we're representing all those different viewpoints Tom was talking about as we reshape banks for a new era, John. And I do think that the reshuffling will play into what they testify.
Morgan Stanley this morning, Tom, JP Morgan a couple of days ago.
Yeah. And I would remember, John, I'd mentioned also that Ruth Port went out to Google here. Mr. Pruzan took over those duties. And, you know, there's been, each of these stories is different. No one better at Bloomberg knows that than Sri Natarajan, who joins us right now. To say he's Bloomberg Wall Street reporter barely describes the king of gossip of Wall Street. Who's next? Is Goldman Sachs going to have a shakeup?
Well, Goldman Sachs is one of the recent firms where we've had a CEO shakeup. So you saw that in 2018 when Lloyd Blankfein went out, David Solomon came over.
I need some more fun from these firms. Is Goldman Sachs next?
If Jamie Dimon is going to take 15 years and James Gorman won the same time, I bet David Solomon doesn't want to leave anytime soon.
Sri, the co-president's role, can we talk about that a little bit more? How on earth does that work?
Well, at least at this firm, it is important that the Morgan Stanley of today is extremely different of the Morgan Stanley from 10, 15 years ago. You have a firm that is not a pure play Wall Street investment bank anymore. Its wealth management arm contributes to nearly 50% of its overall revenue. So it kind of makes sense to pick someone like Ted Pick, who has charge of the entire investment bank, and Andy Saperstein, who's really built Morgan Stanley into a wealth management powerhouse, starting from 2010 with the Smith-Barney purchase through to last year with the E-Trade buy, which was one of the biggest deals, possibly the biggest bank deal since the financial crisis, that it has become a major center of gravity for the firm. So at Morgan Stanley, you had to have a situation, even without any inside knowledge, the best guess anyone else out there would have had was the most logical outcome here in trying to figure out who will be the top deputy to James Gorman would have been these two men in Ted Pick from the investment bank and Andy Saperstein from the wealth management side.
So he wants 3 years. He's told the board another 3 years as the CEO. Many people reflecting on what happened with Citigroup in the last couple of years, where Mr. Corbat said something similar. Then all of a sudden, Jane Fraser just started to move really quickly. Was the Citi situation unique, or do you expect, as some people expected, to see something similar here?
Citigroup and Morgan Stanley, two very different places right now. In fact, Morgan Stanley's market cap is even higher than Citigroup right now. Imagine saying that a few years ago. That would not have been considerable. Even now, Citigroup has twice the assets of Morgan Stanley. And Citigroup has been going through a number of challenges on the regulatory front and elsewhere. Morgan Stanley is a different story. They are in a good position. They are in what James Gorman calls a position of strength. And when the going is this good, it's hard to imagine you would want to leave. And that's why it makes sense when James Gorman is talking to senior management and the board and saying he wants to hang around for at least 3 more years.
Sri, if you buy the argument that banks are reshuffling senior management ahead of the bank hearings in Washington, D.C. next week, what is the message being sent by the personnel choices, by the moves being made?
Yeah, I'd have to take the contrarian side here, Lisa. I'm not sure the Morgan Stanley move necessarily signals much to DC. However, the pandemic could very well have played a role. It is our understanding that James Gorman has been working on this succession plan, at least for a good part of the last year. He does this New Year's resolution every year where at the start of the year, he puts out a list of things he wants to accomplish. And this year, it very much was on the list to make sure there is a smooth transition of power. And that's important for him.
Sri, it's sort of old school to me when I waltz through the biographies of the guys. Edward Pick is a guy who's seen it all. He went over to the equity capital market side, and then he entered the Death Star, the fixed income shop, which at Morgan Stanley was an absolute train wreck for years. Is he advantaged here because he has equity capital markets and bond capital markets experience?
He certainly does bring big credentials with him. When you say he was started off on the equity capital market side, he helped with the IPO of none other than Google. So he's had some big ticket names that he helped take public. Then he took over the equities business. And in the aftermath of the financial crisis, that was a big challenge to make sure that they could lift Morgan Stanley's equities business. And now it is the #1 player on Wall Street. And then he helped a fixed income business that was flagging. So he's clearly built up the credentials. He's notched up the wins. So his star is certainly very much on the rise.
Sri, tremendous reporting as always, and good to catch up with you, sir. Bloomberg's Sri Natarajan breaking down the news coming out of Morgan Stanley. The top line, the headline, I think, this morning, before we get carried away, James Gorman telling the board he plans to remain CEO for at least 3 years. It's a management shake-up, planning for transition in 3 years potentially. Pick and Saperstein, Tom, emerging as the likeliest heirs, looking at this right now as the co-presidents.
And John, what's so important is when you do this, when you elevate these guys in a certain bracket, one of them is going to be head of strategy. So Sinkowitz, I have no idea what a head of strategy does. I thought that was your title, John. But the people come up underneath these guys. So it's not just about the 4 faces on the screen for you on radio.
You know what the cynical would say, Tom? That for the CEO, it's good if they fight between themselves and not with me.
Are you a cynic?
This is
just suggesting that some leaders quite like that situation, especially if you want another 3 years or another 5 for that matter.
I don't know how you succeed without debate. I mean, you got to have debate.
So true, Tom.
And clear through it. And surveillance. We're all,
Kumbaya.
Kumbaya.
Is that this show?
This is Dr. Phil incarnate.
We got Sage
I had no idea I was head of strategy.
Yeah.
I'm told.
Vet Bill's head of strategy. Robert Miller joins us now with BlackRock, head of America Fundamental Fixed Income as well. He's been watching the deck chairs move at J.P. Morgan, at Morgan Stanley. Bob Miller, are we going to get an announcement out of BlackRock? You want to get out in front of the story?
Really?
I don't think Bob wants to go there this morning. I'm not shocked, Bob.
Bob, I got to talk about yield with you, and I'm going to go full faith and credit right now, and that is the idea of a 163 up to a 167. What is the importance of a rising yield now? What signal does that give?
Well, Tom, the market, good morning, first of all. I hope everybody's well. The market reacted yesterday to the minutes. Frankly, we didn't see a lot of signal value in the minutes, but I think to the extent that the market teased out a tiny tilt toward more people wanting to talking about tapering, that's directionally accurate with our point of view. As you know from my colleague and our CIO, Rick Reeder, who's been quite public about this, and we are very much in the camp that the dual policy settings right now are between monetary and fiscal are disproportionately accommodative relative to the remaining costs associated with the COVID crisis. And we don't expect fiscal policy to be recalibrated, so we're looking for the Fed to acknowledge substantial further progress in a world where many, many others, including the CDC, who seem to be at the center of the storm for the past 15 months, have acknowledged material further progress with respect to the virus and the economy, businesses, government, et cetera. It's like the one group that has been resistant to acknowledging progress is our own Federal Reserve.
So, Bob, here's the question for you then. I assume from you and the team over at BlackRock right now, this isn't the prudent policy setting, but this is the policy setting right now. So what are the investor implications right now for you?
Yeah, it's a great question, John. So, I mean, for us, be consistent with other things you've heard. We're fairly defensively postured. We acknowledge that if this relatively low vol, relatively tight spread regime persists, we're probably going to underperform a bit. But we think that our fiduciary duty to our clients is to be prepared for some more volatility in the marketplace and be positioned to take advantage of that and eventually accumulate many more assets at much more attractive valuations. So we're a bit defensive. We think we haven't seen the peak in rates. Frankly, I think real rates are substantially lower than fair value. So we're positioned for rising rates, both reals and nominals. We're expecting that the Fed will, in fact, begin to acknowledge substantial progress, and that the tapering discussion will be on the table sooner than the market currently assumes. And it's important to keep in mind we're talking about dialing back emergency policy settings put in place a year ago at the peak of uncertainty, when it's increasingly clear that the emergency is behind us. So we're not talking about like going from uber dovish to hawkish. We're talking about going from uber dovish to a little less dovish,
Bob,
but still really accommodative policy.
Just about 30 seconds left. What does it mean to be defensive at a time when you're expecting yields to rise?
Well, you're short duration in our accounts, and we're holding more cash than we normally would. So we're less, fully invested in credit product, EM, et cetera, places where you would go to find yield, anticipating an opportunity to reload in those asset classes sometime over the next couple of months at much more attractive valuations.
Well, we've got to leave it there. Bob Miller there of BlackRock, the head of America's Fundamental Fixed Income. Rick Reeder brought this up with us recently. Russ Kostrick did it again this morning. This cash position, you know what? I brought it up several times with other fixed income investors. I was really surprised about the pushback that I got about BlackRock's cash position going into a summer where most people anticipate there is going to be a taper story developing.
You got a grizzled veteran like Bob Miller there, folks, and, to be honest, a huge respect for people that have been through the ups and downs of the wars. I love what he said at the end, John, about the parlor game, to take the phrase from the Fed, of trying to figure out what to do with higher yield, lower bond prices while you wait to quote unquote reload. That's jargon for what do you do in the sweat of higher yields. Mr. Miller's been there.
Bob Miller at BlackRock there on a situation and the cash position they're building going into the summer. From New York City, let's keep things moving. Equity futures down 6. We decline 1/10%. We're recovering. As the session grows older, we recover.
We're moving.
Yields 166.76. Hopefully I'm moving in there at some point in the next 5 years.
That'll be interesting.
This is Bloomberg.
It's hermetically sealed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people.
Okay, guys, let's see. Let's wait what's going to happen with British pound. For time being, you see it's moved on to different direction. Yeah, I will cancel the order to buy. We will see for a couple of minutes what's going to happen. So if you wanted to trade British pound, you need to cancel this order and wait further. I'm going to tell you. Otherwise, you'll be on your own. Right now, if you can see, right now, it's moving up and down, and it's kind of difficult to find out which way right now it will go. See, it moved up. I'll speak to you later. Stay with me.
Just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
For our Bloomberg TV audience, we are waiting right now for Jim Farley, the CEO of Ford Motor, on the announcement of his new all-electric F-150. And as we wait, we want to get a check quickly on the markets with Abigail Doolittle. So, Abigail, markets have had sort of a rough time this week.
It's been a rough week indeed, David. Right now, though, it feels a little bit calm after the storm. Maybe there's another storm ahead, but the futures for the major indexes here in the U.S. basically flat. The tech-heavy NASDAQ 100 futures up just a little bit more. That's interesting, David, because we have yields down. Of course, when yields go down, that helps out tech stocks because it takes away the valuation pressures. So that relationship is acting in sync. But you can see that over the last 2 weeks, really, that we've had the NASDAQ 100 pummeled down 3% on these inflation fears. And it's not the inflation that we're seeing for the 10-year yield, because you and I have been talking about it. Nominal yields have basically stayed stuck, but the inflation has been in commodities. Interesting, though, David, it's gone up, and then more recently, we've seen some of the commodities really go round trip, whether it's lumber, copper, oil. So it's going to be a market to watch to see whether or not that inflation that is showing to some degree in commodities translates into nominal rates, David.
So, Abigail, we like to talk about transitory when it comes to the 10-year. What about idiosyncratic? For example, the oil you mentioned, I think, has to do with rumors, reports, perhaps, of a deal with Iran.
Well, you know, oil, that has been a pressure on oil more recently, but I think at the end of the day, it's all the liquidity in this system, what we've been talking about, too many dollars chasing too few assets. And so when the fundamental stories die away to some degree, traders chasing those assets, afraid that they're going to miss out. A classic case of that today, of course, this week, I should say, with Bitcoin at one point down 30%, then up 30% over the last 2 days, now down about 3%. A real roller coaster there, David.
Yeah, we couldn't get through a market check without talking about Bitcoin, right? Has it had any real effect, though, on the markets, do you think, besides on crypto itself?
You know, it's probably more a sentiment barometer. You could make the case everybody wants to know why has crypto gone up so much and then down. You know, last year there was a lot of talk about bubbles and froth, and this is the other side of it. Perhaps Bitcoin shouldn't have gone up 600% over the last year on no real fundamental reason. What goes up must come down, so we're starting to see some of that this week, David.
Yeah, perhaps it was just a little bit overinflated, Abigail. It's a really courageous call on your part. Thank you very much to Abigail Doolittle for that report on the markets. And now to our Bloomberg television and radio audiences worldwide, we're delighted to have with us the Ford CEO, Jim Farley, as his company unveils the new all-electric F-150. Jim, thanks so much for being with us. So I have to congratulate you first out. I'm not remembering another time when a president of the United States sort of endorsed a new car and gave such a pithy endorsement for it, said the sucker's quick. So what can you tell us about this truck besides the fact that it's quick?
Well, thank you, David. Well, first of all, this is an iconic moment for our industry as America's most popular vehicle for decades goes electric. The starting price is $39,000. We have over 20,000 orders in 12 hours since we revealed right here in Dearborn the truck. It can power your house for 3 days. 0 to 60 in 4 seconds, fastest F-Series we've ever made. That's got a mega power front, so the whole front where the engine was is lockable, and you can put 400 liters of stuff in it. It's an incredible new vehicle. that I think America's already falling in love with. And yes, the president loved this truck.
Yeah, he clearly did. He got to drive it. I was surprised they let him drive it. The Secret Service actually were a little lax there, I think. So Jim, we know the Ford F-150 has been, I think, the #1 vehicle in North America for something like, 40 years, more or less?
44 years.
44
years.
And largely, it's really a truck for the trade. It's used by a lot of construction workers, people on the job site. So will this cause people to give up the old F-150 and move over to the new electric? Are you seeing a more rapid turnover in your fleet?
Well, first of all, we have a special lightning just for the trades. We are the leader, almost 50% market share in commercial light-duty vehicles, so Ford is by far the leader. We also have an e-Transit. Transit van is the #1 van in the U.S., and we have an electric version of that coming out late this year. So the only brand who has both commercial versions. The F-150, with going electric, you reduce about 40% of the moving parts and powertrain. So the cost of ownership and uptime is much, much lower for an ICE if you have the duty cycle of driving as a commercial customer. Commercial is really different than retail. They don't overbuy in batteries. They know exactly how many miles they're going to drive. So this vehicle is a real game changer for commercial customers where we are dominant. For retail customers, it's really fun to drive. It's got the upscale content, the 15.5-inch screen, the over-the-air updates. So it's going to be kind of a new vehicle. We have a hybrid and turbocharged and a diesel version of F-150. So when you sell 1 million, we have a lot of different choice. We're going to let the customers decide which one they want.
Well, but you must have some anticipation of what the customers are going to want. And let me ask you a very pointed question. When do you expect you'll stop making the internal combustion engine version of the Ford F-150?
We'll do that when customers choose to do that. We have the option. We have a lot of flexibility. That's why we got the price down to $39,000 to make it affordable. We want to lead this electric revolution, but we have a lot of customers who drive 600 miles a day. Electric just not going to work for them. But we definitely see the fleet going more and more electric. We have the Mustang Mach-E that's already sold out for several months now. And we have the e-Transit, as I mentioned. So we're going to give the customers choice. We do have a production plan. The president was here to see our Dearborn facility where we're going to make this vehicle. My grandfather worked there in 1928, so it's a great facility, and we'll just let the customers decide. We just announced a battery plan for this vehicle down in Georgia, and so we're getting ready for the launch.
By the way, that's when my grandfather was working for Buick Motor up in Flint, Michigan, so just up the road a piece. But give us a sense here about what this will mean for labor, because President Biden has said he really wants to embrace electric vehicles, as he did when he came out to Detroit, in part because of the good-paying jobs. At the same time, Ford, as I understand, is estimating you need 30% less labor to make an electric vehicle than an internal combustion engine vehicle.
Well, you're spot on. It does take less labor, about 30%, we think, because the vehicle is just a lot simpler. But on the other hand, we're vertically integrating to offset that labor tail. So we're going into this battery production in large scale. Those are new jobs, very different kind of jobs. We're also building electric motors and inverters inside the company. We weren't doing that before. So we're taking our transmission plants and converting them over electric components. And when you look at all of those pieces, there's not really a big labor transition here, but they are very different jobs. And the other thing is the labor happens in different places. So we have to transform the labor in terms of geography footprint. That's a big job to do. It's going to take a long, decades for this to make this transition, but we're already thinking ahead.
Jim, in success, you're talking about an awful lot of batteries. As I understand it, Ford is making another announcement today about a joint venture. What can you tell us about that?
Yeah, so this is a big deal. It's Blue Oval SKI. We're going to accompany SKI. We're going to go into the battery production business. Something we used to buy off the shelf, we're now vertically integrating these batteries. They're too important for this volume. We want to secure the production, and they're a really big part of the bill of material of this F-150 electric. That's why we got the price down. So we need to integrate these batteries. These are very specialized plants. This is going to be in Georgia. It's a big announcement for us to go into battery production, and it won't be the last place that we vertically integrate.
Well, let's talk about that exactly, because one of the things that's very much in the news is the shortage of chips. In fact, I read at least that you have 22,000 of the old, if I can call them that, F-150s sitting in a lot in Kentucky because they don't have the necessary chips. Where are you in the chip production facility? As we have a summit going on in Washington right now, can Washington help you?
It's a big deal right now. And so we think second quarter is really the trough for our chip supply shock. We think the second half is going to improve. You know, we've cut our production almost 50%. The chip issue is complicated, but we really see the Renesas facility that really impacted us in Japan. They're back up and running. They had a fire burn the whole plant down on March 19th. They're back and running, and we're confident that in the second half we'll get most of the chips we need. The demand is so high for new vehicles right now that I'm not sure we'll get all of what we need. We've rescheduled all of our summer vacations for our hourly workers into this quarter. So the third quarter and fourth quarter, we're going to be flat out on production. It'll really come down to how many chips. And you know, the chips we use in these vehicles is very complicated. We have hundreds and hundreds of them, and we tend to use the 22 nanometer and bigger chips because our requirements are different than your phone. Our trucks have to work at 40 below in the North Slope of Alaska, so we tend to use those older feature set chips, and that's not the capacity that's going in. You hear all these big announcements on chip capacity. Those tend to be the smaller, more advanced nodes, and we use a lot of those, but not all of those. So it's going to be a big transition to get more capacity for us in these the chips that we mostly use.
Jim, I'd be remiss if I didn't ask about the competitive front here when it comes to chips. Ford sort of took a hit in saying you had a lot of problems with chips. GM appeared to come across as being in better position. Is that fair? I think the street right now thinks that, in fact, GM's managing the chips better than Ford.
You know, I can't influence other companies, but here's this management team's commitment. We are going to tell Wall Street everything we know. Okay, that's our plan, is to be completely transparent. How it falls out in the market, I think it's going to take time. So let's see how the end numbers, work out. But our management team, we want to share everything we know. And that's what we knew. And we shared it as transparently as we can. Look, we were able to offset almost all of the chip impact, 200,000 units in the first quarter. Right. So let's see what this team can do in the rest of the year.
Well, we're really looking forward to driving that sucker, as President Biden refers to it. That is the new Ford F-150 all-electric vehicle, available, as I understand it, next spring. Thank you so very much to Ford CEO. He is Jim Farley, coming from Dearborn, Michigan. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Expect clear, consistent precise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television. Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now with equity futures turning positive on the S&P 500. We advance 0.2%. We begin with the big issue, talking about tapering.
There was finally some acknowledgement of the thinking about tapering. The minutes were very interesting.
They are thinking about talking about tapering.
It was a surprise to hear the talk about Fed tapering.
This is important. The Fed is likely to start to shift their policy stance.
I don't think it's the time to bet on withdrawal.
It's not unrealistic to think you begin tapering in Q4. The Fed is resolute.
Everybody's going to remain focused on inflation.
This is a big deal, but the wheels are not coming off the vehicle yet.
Not tapering as yet.
We're going to continue to see this debate around inflation.
No one knows if these inflation pressures are going to prove more transitory or less transitory.
It'll be very interesting to see how that plays into inflation expectations.
Joining us now is Morgan Stanley's Matt Hornback, JP Morgan's Phil Guarco. Guys, it's almost tedious to go through this, but let's do it. Matt, your reaction?
I mean, John, people in the market have been talking about tapering since January. I don't know what more I can say. I don't see how this is any surprise. And if we had gotten another 1 million jobs in April, certainly we should be talking about tapering. But, John, we didn't. So I don't see what the big deal is.
Hey, Phil, your take.
Yeah, I kind of agree. I think that the big question is going to be how they manage the communication going further. They've already told us they're going to be looking at the data. But I think one important thing to remember is that the first communication error made by this Fed was back in December of 2018. And they started these conversations a bit too early. So I think that talking about tapering is really a way to ease into it because we had that correction at that time and they had to reverse course in January.
Well, here's the quote from the Federal Reserve from the FOMC minutes. A number of participants suggested that if the economy continued to make rapid progress towards the committee's goals, it might be appropriate at some point in upcoming meetings to begin discussing a plan for adjusting the pace of asset purchases. Now, I can cut this up 3 different ways, Matt Hornback. Maybe the more important piece is rapid progress. This predates a pretty messy payrolls report that came after this meeting. Does this date the whole thing?
I mean, John, in my opinion, yes. And the other thing I'd point out in that part that you just read out to the audience is that they were talking about starting a discussion. This doesn't even mean that they're going to provide the very clear forward guidance that Chair Powell has been talking about. So our view is that by the time we get to the September FOMC meeting, when the committee releases their next set of projections for 2024, we think that is the time that they might be ready to provide this forward guidance. But bear in mind, John, that presupposes that the job gains over the summer remain or return to a rapid pace of growth. I think there are legitimate questions around whether or not that's possible here.
Let's turn to Ira Jersey of Bloomberg Intelligence, our chief rate strategist. Ira, your take on a situation at the moment, excitement about nothing or significant?
Well, I think it's significant in that the market thinks it's significant. And when you look at what happened with that line in the minutes yesterday, you saw a 10 basis point sell-off in 10-year TIPS yields. And I think that's where a lot of the pain will come once it's clear that the Federal Reserve will be cutting back their asset purchases. Real yields have been very negative, historically negative for the last year or so. And I think that can reverse in a hurry because I think, the Federal Reserve, having bought so many nominal bonds as well as tips. Once they cut back on that, you're going to see some pretty dramatic moves in the market and in the rates market in particular.
Ira Jersey nailed it. Ira, thank you, by the way, for joining us quickly. Nominal yields didn't move much in yesterday's session. Phil Guarco, real yields did. Is that what you're laser focused on?
Yeah, of course. I think reals are the thing that we have to pay a lot of attention to because they are just so low. But I think going forward, I think that we should have expected some of this to come out, and especially with the movement in commodities yesterday. There was a great article in Bloomberg that came out about 3 weeks ago, and it really talked about backwardization. And I think that even though we're getting this scare now, if you look through it, the markets have been telling us that commodity prices are going down, and this will ease. So as I've said before with you guys, I think what we're going to be focused on is when do we go in? When do we buy long-term duration? Because this is going to be an opportunity to get back into fixed income here.
Well, Phil, let's have that conversation right now. Matt Hornback, you've made the argument that many of the prominent risks are already priced in. You still have that view, I assume.
That's right, John. And to me, actually, this is a little bit less about real yields. It's more about the level of break-even inflation rates. When we are looking at the break-even inflation market and what it's pricing for CPI fixings over the coming year, we see a path for inflation that is even higher than what our economists, who have been above consensus on inflation for a year now, are projecting. So, to me, it's really more a fear factor that is built up in the break-even inflation market, which, by the way, John, to bring another market into this, has, I think, weighed on the dollar over the recent month or two. So at the end of the day, we think ultimately these break-even inflation expectations are going to have to moderate somewhat as we make our way through the summer.
DXY this morning, back with an 89 handle, a sneak peek of life below 90 this week. Why then, Matt Hornback, do you like the steepness still? 5s out to 30s. Why?
John, for us, how do you make hay when the sun barely shines? And we think the way you do it in fixed income markets is by focusing on roll down and carry strategies. The yield curve steepener is a great way of doing that, in part because we still think that Fed policy is mispriced in the front end. So there is some risk premium to monetize there, and we're recommending investors monetize that through curve steepeners.
Phil, do you like the steepener too?
Yeah, we do. But again, I think what we're looking to do is try and look a little bit past that kind of data. I think what we're really focused on is the manner of getting out of this crisis is going to add a lot more debt. It's going to have effects on the capabilities of the Fed to do things in the future. And frankly, the velocity of money still keeps going down. So yeah, we're going to get this scare now. That's an opportunity with the steepeners. But longer term, I think that there's going to be, again, a great opportunity to buy duration once the steepener trade is done, because the medicine that has gotten out of this crisis may just be setting up for lower growth in the future.
Have you got a number in mind, Phil? It's the second time you've said it. What's the setup? What's the playbook here?
Yeah, we started at 2%. If we go to 2.25, I think we go in even further. I think the question is going to be how we do it, the manner in which. I think right now there's some opportunities in emerging markets debt, especially in commodity countries. I think going forward, though, the opportunity is going to be in U.S. investment grade debt once we hit that 2.25 range. And I think that's time to lock in for the future and, more importantly, improve your portfolio construction in the future, because that longer duration of high quality assets is going to provide a buffer going forward.
Your 10-year this morning,
60-40
166. You want to wait until 2% still, Phil?
I'd like to, but I think we're going to find opportunities a little before that. So maybe I'll be cheeky and start looking to buy a lot more at about 190 so as not to miss the opportunity.
Well, you let us know when. Phil Guarco at JP Morgan, Matt Hornback at Morgan Stanley. Gents, thank you. In your equity market, bit of a pullback, then a recovery this morning with some movers. Here's Abby.
John, let's whip through what's happening, and that is Big tech is leading. Banks are down. This, of course, as yields are down slightly, that 10-year yield at that 166. So Apple and Tesla are really helping the NASDAQ 100 futures outperform. On the other hand, you have some of the banks, especially those tied to rates, Wells Fargo and Bank of America down. Morgan Stanley, though, getting a small bid as they have announced C-suite changes, specifically Ted Pick and Andy Saperstein to become the co-presidents. And then the crypto space, it has recovered. There's some stabilization there after the wild ride that we've had this week with Bitcoin and Ethereum up slightly. You can see Coinbase, Marathon, Riot Blockchain, all higher, John.
Abby, thank you. Coming up, some morning calls. Your equity market recovers. It's Thursday morning. Good morning. This is Bloomberg.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Away from the opening bell in New York City, equity futures recover from the losses earlier on in the session. We're positive by about 8 points on the S&P, up 0.2%. Broader story for the equity market this morning: the Nasdaq up 0.4%, and a nice little lift in Europe too. The FTSE 100 up 0.4. The DAX, the equity benchmark in Frankfurt, Germany, up by 1 full percentage point. That's the price action. Transatlantic, let's get you some morning calls. A look at some of the analyst recommendations this morning. We begin first up with a call from Bank of America, upgrading Viacom CBS to a buy from underperform. The analyst calling the company a prime candidate for another potential acquisition. That stock is up by more than 4%. Argus downgrading Merck to a hold. The analyst warning that the company's upcoming spin-off would reduce operating margins. And finally, UBS upgrading Chipotle to a buy, a $1,700 price target. The analyst expecting a notable increase in traffic as the economy reopens. There are three of the calls. The opening bell is next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
23 seconds away from the opening bell in New York City this morning. Good morning. Your equity market coming off the back of a 3-day losing streak on the S&P 500 and looking to take a little bite out of it. The equity market up 0.2% on the S&P. The Russell advancing a little more than 1/10. The NASDAQ up 0.4%. There is your opening bell this Thursday morning stateside. Switch on the board into the bond market. Treasury yields look like this on a 10-year, coming in a basis point, 165.74. Some mixed economic data from earlier this morning. Claims coming in better than expected, more than expected. The Fed business outlook, not so good. Euro dollar 122.11, dollar weaker, euro stronger, euro dollar up 1/3% here, back through 122, and WTI crude down about 1/3 at $63.10. That's the cross-asset picture this Thursday at the market desk with your movers. Here's Abby.
John, well, there clearly is a little bit of a relief rally this morning from that 3-day decline for stocks, specifically the S&P 500 and NASDAQ and Dow this week. A lot of pain there. But today, before taking a look at what's helping, let's look at a little more pain. Cisco Systems shares are falling. This after the company beat, but they had to bring in their profit forecast because it was hurt by rising component costs. They're saying the supply chain squeeze is likely to last until the end of 2021. The stock off of its lows, but nonetheless down 2.6%. As for what is driving that relief rally, it's all about big tech. Apple, AMD, Tesla, Google, lots of tech winners driving higher as yields are ever so slightly higher, but it feels like it's more by the dippers wanting to take advantage of the fact that yields are in and they see an opening here. That's true too for crypto. If we take a look at both the underlying assets of Bitcoin and Ethereum, we are going to see gains, as is true for the Bloomberg Crypto Index, up 9%. What a difference a day makes for the crypto space, John.
Abby, thank you. About 90 seconds into the session, we're up 1/3% on the S&P, recovering from 3 straight days of losses. Energy, a move to the downside by 0.2%. Consumer discretionary, top of the pile, up 0.6%. As Abby pointed out, this follows a wave of volatility across riskier assets. Michael Schall, wary of the big swings we've seen in crypto. Take a listen.
3 years ago when Bitcoin blew up, it really didn't matter. But right now, there is some real institutional money and some real wealth management money in Bitcoin. And of course, there's a significant amount of market cap.
A significant amount of market cap, and that makes the difference. With more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, that was an interesting comment from Michael Schall, because I was talking to the CIO of Bitwise Asset Management yesterday, and he said it was retail that was panic selling, driving Bitcoin lower, and then the institutions that actually came in to buy the dip and maybe stabilize things. But nonetheless, it was a very volatile session. We saw Bitcoin dip as low as $30,000 before rebounding to close at around $38,000. And once again, that dip buying is continuing today. We're trading back above $42,000. All that said, though, John, we are still just around the levels where we were back in February when Elon Musk first announced that Bitcoin was going to be added to Tesla's balance sheet. So a lot of froth has come off the top. And that isn't just true for Bitcoin. Think about all the assets that were so hot in 2020. Clean energy, SPACs, technology. Their stories have looked a little bit different in 2021. When you look at the iShares Global Clean Energy in ETF, that's the blue line here on this chart. Since its peak in January, it's down more than 30%. The SPAC index peaked out in February. It's now down 23% from those levels. And unprofitable tech companies have come under pressure, true. You can see that you can see that evident elsewhere, including the ARK Innovation ETF, Kathy Wood's flagship fund, and then some of those meme stocks had been seeing a resurgence. AMC up 8 days in a row until yesterday when it then got caught up in that risk-off tone. So this really, the volatility in Bitcoin has kind of bled to other frothy areas of the equity market, John, and what that has done is raised volatility really across the board. Remember, we were looking at a 16 handle on the VIX just last month. Earlier this month, we hit a 27 handle, and this morning we're still above 20, John.
Looking at 20 now. Kaylee, thank you. John Hancock's Matt Miskin responding to this, looking for some opportunities. This is what he had to say.
We've gone a long way here, 80–90% off the lows just over a year ago. We're due for some corrective price action. Looking at the crypto space and lumber and some of the other places where momentum has been hot, that is where the selling pressure is coming in the most. We think that makes sense. But in the rubble, we would look for opportunities. We think this resolves itself.
We think this resolves itself. Joining us now is Nuveen Sarah Malik and Barry Knapp of Ironside's Macroeconomics. Now, don't worry, guys. I'm not going to spend the next 10 minutes talking about crypto. But, Sarah, I'd love your response to what's been happening more broadly in this market and that shift higher in vol that we saw yesterday.
I think what investors are dealing with is this trifecta of an upcoming peak in earnings growth, higher than expected inflation, and premium market multiples. This is causing volatility, and we need to get through a couple of these hurdles before we can settle down. You know, earnings growth and market multiples, they're coming off very high levels. We think investors will handle the fact that we're going to go into 2022 with more like mid-single, but still positive earnings growth. But inflation is a key issue here. The numbers are going to come in higher than expected over the short term. The question is, will the Fed blink and pull that ripcord early on easing? What we see it as is supply is unable to keep up demand. That's a short-term issue. And also we think that over time, as we shift our spending to services and away from goods, that should start to settle inflation down later this year. So we should be able to get through this issue and move forward from here with market upside.
Sarah, I'm going to come back to you on that point because there's a couple of really good points in there that I want to pull you up on. Barry Knapp, your reaction?
Well, I think that we've sort of forgotten about one of the key drivers of rates going higher, of the move in crypto. I'll bring it in, get myself involved a little bit, John.
Please do.
Was really from early January through mid-March when the blue wave was ushered in, and it looked like eventually they spent $1.9 trillion, not 800 billion. 800 billion. That drove a major repricing in the back end of the real rates market, right? So 30-year real rates went from -40 to +20. That was the incremental ease. We already knew the Fed was buying 120. We're debating when they're going to stop. You know, I'm at Jackson Hole to start the process is my call. But the incremental liquidity into the system came from that fiscal impulse. Right now, that agenda has stalled somewhat. We're undergoing bipartisan negotiations. In about 2 weeks' time, the Biden administration is going to have to make a decision whether they go for the smaller Republican package or go back to the big package and file for reconciliation. And we find out whether they want to borrow another $1 or $2 trillion in deficit finance spending. That could potentially be another, driver of liquidity and a surge in, all these reflation-related assets. But that, to me, is why all of this, SPACs getting hit, crypto coming down, high valuation equities being hurt, is because that agenda, spending agenda, fiscal impulse has stalled out.
Well, Sarah, let's pick up on that then. Do you think we are approaching an inflection point for policy?
I mean, definitely yesterday the Fed sounded more hawkish, but we need to keep it in perspective. They're trying to communicate. They also said that we're nowhere near targets in terms of employment or pricing. And I think the moves that they make will be based on stronger growth. So again, this is about the investors adjusting. We are definitely going to be moving to an environment where it's less accommodative over time. We need that growth to pick up to be there without a huge permanent spike in inflation. So it is not going to be as easy as it's been in the past, but we don't think that that necessarily means that that's the end of the cycle unless that inflation number stays so high and we start to crimp growth and then the Fed pulls back. And of course, at that point, things would unravel, but that's not what we see for the medium term.
Sarah, I'd love some more detail on your inflation call as well. I have a lot of people come on this show, particularly over the last month, talking about peak rate of change, and that's in the data, you can see it. I don't hear many people talking about peak inflation expectations, and I wonder from your standpoint, what you'd use to guide any conclusion you draw around that.
I mean, we're watching within the numbers. One key is wage inflation. If wage inflation becomes very broad and strong, we think that would be a bad sign, and it'll be more than peak inflation. It'll be more of a long-term plateau in inflation, which could be a negative for the markets. If we see pockets of inflation, we're fine with it. One thing for us is how do you play this short-term spike in inflation? We're looking at things such as the refinery market, looking at gas inventories are below average levels. We're just hitting that summer driving season. This is companies like Valero, very well positioned for higher gas prices with low inventories, very good capital management for this company, an upside to normalized earnings. There's other companies like Bunge that also higher soybean and corn prices as China rebuilds its livestock due to the swine fever that hit there. These are companies that you can own to capitalize on this higher inflation that we're going to see for a period of months at least.
And to leverage the higher commodity story, and just to go through three of the calls again, Sarah, you mentioned two of them there. Valero one, Bunge another, Diamondback Energy, the pure play on the Permian. Now, Sarah, I just wonder, this time around, with this huge commodity ramp up that we've seen, are you confident that we'll retain the discipline for some of these energy producers, some of these commodity players?
The key for us in energy is more about making sure you own the well-positioned companies. So a company like Diamondback is a low-cost producer, dominant in the Permian Basin, a strong management team, very good execution. Interestingly, they're not focusing on supply growth, and that's what we want to see. They're going to return more cash to shareholders, help make sure that they focus on maintenance capex so that we can keep that supply-demand balance in energy in the favor of the energy company. So it's not about owning every energy company. It's making sure you own those low-cost, well-positioned ones like Diamondback Energy.
Do you like the energy story, Barry?
I do. I upgraded energy in December and very much like it. And more broadly, to that whole inflation thesis, I think there's been a bit of a so-called jumping of the shark. We were in a disinflationary regime for 30 years. We're going to a reflationary boom. And what happens is there's a very big focus or fixation on your marginal cost story, prices paid versus prices received. But fixed costs are not going to change all that much. So when you have your revenue growth go up, even if it's primarily a price effect, that widens your profit margins. And that's part of the energy story that Sarah's talking about. If Diamondback, I don't know the company like she does, obviously, but if they don't do a lot of drilling, they just wind up with much bigger margins as a consequence of higher oil prices, which, I think is inevitable. So, I think this is a really good environment to be long energy, materials, industrials, and financials. And that's still how you should be positioned. It wouldn't be too underweight tech either. There are some real cyclical components. Semis have started to act better in recent weeks. So that's how I'd be thinking.
Well, Barry, let's do a couple of things then. Let's come back in a moment. We'll talk about the banks call, and we'll get into tech as well. Energy on the year, on the S&P 500, up a little more than 34% year to date, that sector. Sarah Malik, Barry Knapp, sticking with us. Let's get back to the price action in the moment. About 11 minutes into the session. Here's Abby.
John, we have a modest rebound rally on our hands, especially for the NASDAQ 100. The tech-heavy indexes are outperforming. One off driver, Virgin Galactic shares are soaring higher at the highs of 26%. At that point, the best day since March of 2020. This is the company saying that their next test flight is on May 22nd. One analyst on the street saying it was thought that this would happen in 2 to 3 weeks. So shares clearly responding well. As for what's really driving the markets, of course, has everything to do with big tech. Let's also throw some crypto in there because we have a nice rebound there as well. If we take a look at the shares of NVIDIA, Tesla, Coinbase, Marathon, stocks that yesterday investors were really dumping, today they're picking them up hand over foot. So lots of strength here for the momentum space, having to do with the fact that yields are lower, taking off valuation concerns, but yields lower, that of course is driving the big banks down. JP Morgan and Bank of America near session lows. Energy, John, down again. I believe it's been the worst performing sector all week. Once again, the case, Exxon and Chevron weighing.
The big winners of the year, the losers of this morning. Abby, thank you. Coming up, we'll stick on the banks. Another shake-up on Wall Street. This time, it's Morgan Stanley. That conversation just around the corner with Nuveen Sarah Malik and Barry Knapp of Ironsight's Macroeconomics from New York. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Traffic. Okay. During the pandemic, no traffic. Okay. Where do you see oil market in about 20 years or so? Non-existent.
If you ask me where value opportunities exist, so where can I find, I think, stocks with low PEs and greater likelihood of appreciation, I would go towards financials there. If you look relative to the market and relative to history, that's where the greatest opportunity sits right now, is in the financial sector.
Investors looking to the financials as the C-suite on Wall Street continues to shake things up. Morgan Stanley, the latest to announce a reshuffling. The CEO, James Gorman, eyeing a potential successor, saying the following: "I'm highly confident one of them will be the CEO in the future. It feels like the right time to more formally set up a transition over the next 3 years." For more on this, let's bring in Bloomberg's Shonali Bassek. Morning, Shonali.
Morning, John. You know, you have two co-presidents here finally named. This was a move we've been waiting for 2 years, since Colm Kelleher said he was going to be stepping down from Morgan Stanley. Closely watched roles on Wall Street. So those roles go to Ted Pick, and they also go to Andy Saperstein. And they run really two of Morgan Stanley's biggest businesses. That's the institutional trading desk and the wealth management business. Four-way succession race here, though, John. We have also Jonathan Pruzan and also Dan Simkowitz, who now leads a $1.4 trillion asset manager. As you can see, there is a lack of diversity at the top here in this race compared to what we saw over at JP Morgan just a couple of days ago. But we do have a strong bench here, been at Morgan Stanley a long time, and all four of these men have been firing on all cylinders. And, you know, three of them have really started in investment banking. So that tells you a lot about where the future of Wall Street is going and the future of Morgan Stanley.
Shonali, you touched on JP Morgan earlier this week. There's one thing that journalists are allergic to, just don't believe in: coincidences. I don't know why. Is this just a coincidence this week that we've heard this from JP Morgan and we've heard it from Morgan Stanley too?
You know, it's the annual meetings of the firm. So you do have a lot of investors talking. You have these firms already thinking about their future. Neither of these CEOs are stepping down anytime in the next couple of months, let alone next couple of years. So we'll watch this race continue. But they also, by the way, if there is any coincidences, that they go to Washington next week. So they will be facing a lot more questions about their future in just 1 week from now.
3 more more years for James Gorman. Is it still the rolling 5-year view for Jamie Dimon?
He has not given an updated timeline, but until that time, all of these new successors are a bit younger. There is more that investors want to see from them.
Interesting.
To lead these very large businesses now, John.
Busy week for you, Shonali. Great work as always. Shonali Bassett, thank you. Back with us, Sarah Malik and Barry Knapp as well. Sarah, let's come to you on the banks. What a year it's been. I think they're up 30% on the S&P 500 so far year to date. Reasons to stay with this sector?
Reasons to stay are continuing higher yield and inflation, and also valuations. Morgan Stanley is a company that we like. We like their balance sheet light model. We think it makes their business less volatile. With 2/3 of their business now in wealth management and asset management and the Eaton Vance deal, we think they're actually very well positioned to capitalize on this environment for financials, and also with the positioning of their company.
Is that the best bank to pick for a high yield play though, Sarah?
I don't think it's the most leveraged to higher yields, but our call is not just that yields continue to go up. So we're looking again for companies that have very good positioning in the industry also, rather than, if you want really well positioned to higher yields, you could look at something like Bank of America, but we're bigger fans of Morgan Stanley given that the way that they've changed their business model over time.
And Barry, you said you like the banks too. Why?
Because of the credit cycle, and I also suspect that we're going to have a pickup in loan growth through the course of the year. I also like Morgan Stanley. I like their business model. Wealth management is a growing part of the business for sure. I am hoping that we get towards September, October timeframe, we get a resolution of this whole supplementary leverage ratio issue, which is trapping cash in the banks. That's not such an issue for Morgan Stanley, but certainly is for the larger banks. If we can resolve that issue and get credit to flow a little more freely, a little looser regulatory environment, and I do think that loan growth will pick up as we move away from the depths of the pandemic, then the sector could do well in terms of getting return on assets back to where they were pre-pandemic, and return on equity to something like 12 or 13%. That'll really be a boom because, as Sarah mentioned, the sector's cheap.
Sarah Malik.
It's really the only one that you described that.
We got to run. And Barry Knapp of Ironside Macroeconomics. Thank you, guys. We've got to catch up. Barry, sorry to cut in as you were just tailing off there. We appreciate your input as always, sir. In your equity market, 21 minutes in. Let's get you some sector price action. Here's Dave Wilson.
Thanks, John. You're looking at a day where really it's big tech kind of leading the way. Technology, communication services, where you find Google's owner Alphabet as well as Facebook, the two best performers among the 11 main industry groups in the S&P 500. You also have that consumer discretionary category higher, home to Amazon and Tesla, though not so much. And, retailing may well be a reason why that group is not kind of keeping pace with its big tech peers. And you kind of have to look beyond the S&P 500 to see one area of focus today: department stores. We got 3 of them that are in S&P's indexes. We've heard from 2 of them in terms of their fiscal first quarter results. Macy's was out on Tuesday. The shares have been down every day since those numbers came out. Today you have Kohl's. People weren't satisfied with the extent to which they increased their sales forecast for the current fiscal year, and that stock's taking a beating, down more than 11%. Nordstrom falling as well. Its results are due Tuesday. We'll see if it breaks the pattern, or whether 2 out of 3, not good so far, whether the third one kind of follows their lead.
Dave, thank you very much so. Energy and financials, bottom of the pile. Information technology, top of the pile, and the bond market reflecting that. Yields coming in by 2 or 3 basis points on a nominal 10-year yield. Your yield right now, 164 on 10s, on 2s, 15 basis points. We come in 3 basis points on 30s to 234. Coming up, the market moving events you need to be watching. That'll be next in our trading diary as we look to count you down to the weekend. From New York, this is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Minutes into the session, here's the equity market stateside. We recovered from the losses this morning. On the S&P, we're up 0.5%. The Nasdaq up by almost 1 full percentage point. IT on top, bottom of the pile, energy, financials, the winners of the year, the losers of this morning so far. The quote of the last 24 hours came from the FOMC minutes. A number of participants suggesting that if the economy continued to make rapid progress towards the committee's goals, it might be time, and I'm going to paraphrase now, to start talking about tapering. Well, look out for the trading diary, because in about 35 minutes' time, you're going to hear from the Dallas Fed President, Robert Kaplan. Now, is he one of those number of participants? I assume many of you think he is. Look out for that. Then later, at 1 p.m., we get a 10-year tips auction. And somewhere in between, the Press Secretary, Jen Psaki, holding her daily press conference from the White House a little bit later. Then on Friday, we get a host of global PMIs from around the world, including both the United States and from Europe too. From New York City, for our audience worldwide, this was the countdown to the open. With equities roaring back from the losses of this morning, on the Nasdaq, we're positive by almost 1%. This is Bloomberg.
Trina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a den